Hey guys, this is Alex Owari from ONG Tax and Accounting Services. So in this video, we're going to continue our analysis and discussion on foreign-owned U.S. disregarded entities, reportable transactions, and the focus is going to be on Form 5472 Part B. But we're going to take a look at the Code of Federal Regulation 1.6038A-2, where the IRS gives some examples on what constitutes reportable transactions. In the prior videos, we looked at year 1. We've also looked at year 2. In this video, we're going to take a look at year 3 transactions. Now, before we start, let me throw a word of caution out there that this video is meant for educational purposes only, and it's not meant to be a legal or tax advice. And if at any point in time you need a legal or tax advice, you always consult a tax attorney or a CPA who's going to help you out. Alright, so the requirement for a foreign-owned U.S. disregarded entity to file a pro forma 1120 and 5472 was codified in Title 26 Code of Federal Regulation 1.6038A-2. And when you scroll all the way down, the IRS gives you 2 unique examples which sets as a guidance for you in case you're confused on what is considered as a reportable transaction. These examples gives you a bright line examples on what you may consider as reportable transaction. Not even may, what you should consider as reportable transaction as long as it's properly defined here. Now, this example may not be all inclusive. There are specific situations that may fall outside of these examples that also may be considered as reportable transactions. So anytime you're dealing with this, you're dealing with a transaction that you're not sure, you should always consult an attorney or CPA to determine whether that transaction is really a reportable transaction or not. Before we start looking at the flow chart and going through the fact and analysis, let's go through the Form 5472 instructions. So over here, the Form 5472 instructs that a reporting corporation must file Form 5472 if it has a reportable transaction with a foreign or domestic related party. The 2 keywords that you need to be very concerned about is whether you are a reporting corporation. So once you're able to determine that, the second step is to determine whether you have a reportable transaction. So let's take a look at the definition of a reporting corporation. So over here, the IRS defines a reporting corporation as either a 25% owned U.S. corporation. If you have a U.S. corporation where a foreigner owns 25% or more, it's a reporting corporation. It could also be an LLC where a foreign person owns 25% or more and where the LLC has elected to be treated as a corporation. The second set of entities that we looked at to see if it's a reporting corporation includes a foreign-owned U.S. single-member LLC. So if you have a U.S. single-member LLC formed in anywhere in the United States and where there is a foreign owner, there's a single member who is a foreign owner and it's to 25% or more owner of the entity, then it's a reporting corporation. So in short, a single member LLC can only be owned by one person. So if you have a single member LLC that's wholly owned by one person, it's a reporting corporation for the purpose of 5472. The third group is a foreign corporation that's engaged in U.S. trade or business and where that foreign corporation has a reportable transaction. It's also required to file Form 5472. Great, so we know the definition. Now we know the definition of a reporting corporation. We also want to know what a reportable transaction is. So for the purpose of this video, we're going to go through the flow chart. As I stated, we're going to go to combine this example 1 and 2 together, and we'll specifically look at year 3 because we've already dealt with year 1 and year 2 in the prior videos. We'll come back to reportable transactions very soon, but now let's look at exceptions. Most people would want to have an exception because the failure to file Form 5472 or filing it incorrectly or not filing at all generally comes with a $25,000 penalty. So most people would want to find an exception that takes them out of this reporting requirement. So you could be a reporting corporation, but you will not be required to file Form 5472 if you have no reportable transaction. The first exception here talks about you not required to file these forms if you are a reporting corporation and where you do not have the type of transactions listed in Part IV and VI. So let's go here and look at Part IV and VI. So here, Part IV describe all the transactions that needs to be reported in this form. So if you're a U.S. corporation or a foreign corporation that is engaged in U.S. trade or business, and you don't have any of these transactions listed in here, and then Part VI, you don't have anything listed in here, then you do not have to file this form. So this Part IV and VI generally applies to, number one, U.S. corporation that is owned by a foreign person and where that foreign person owns 25% or more. You could also have an LLC that has elected to be a corporation and where that LLC is also owned by a foreign person and where that foreign person owns 25% or more of the entity. And then the third one that we're dealing with here that needs to worry about Part IV and VI is a foreign corporation that is engaged in U.S. trade or business and where there's a reportable transaction of the type listed in Part IV and VI. So if you don't have any transaction in Part IV and VI, then the instructions is telling you that you do not have a filing requirement. This one, because this one applies to corporations, LLCs that have elected to be corporation and foreign corporation, we're also going to jump into the second line here. So here it says that in the case of a reporting corporation, that is a foreign-owned U.S. disregarded entity, it is also not required to file these forms if it does not have any of the transactions listed in Part V. So let's go and look at Part V. So when you look at this, Part V basically instructs you to describe on a separate sheet any of the transactions that are listed in this regulation. So this regulation gives you guidance on what all the reportable transactions can be. But to also make things easy, the IRS have summarized some of the most common transactions that will be reportable on a separate sheet as long as you check this box and provide a separate sheet and report all the transactions. So for example, the IRS listed transactions such as the amount paid or received in connection with the formation, dissolution, acquisition, and disposition of the LLC. It also includes contribution you made to the LLC and distribution or draw or transfers you made from the entity. So if you have any of this transaction, the instruction tells you to check this box and to attach a separate sheet to describe all the transactions you have that falls within the categories we've mentioned here. As you can see, we focused on the first exception because the rest of the exceptions here generally does not apply to a U.S. single member LLC that's owned by a foreign person, and so there's no need to waste time on this exception from 2 to 6. Alright, so now let's take a look at the examples and then take a look at year 3. So we're going to take a look at year 3, example 1 and 2. So here, we give you the facts and then we go to the analysis and then we also go to the conclusion and we talk about some due dates. So the first fact is in year 3, X makes payment to W. Let's talk about W. W is a foreign corporation. In the IRS examples, the IRS mentioned that W is a foreign corporation, but really W can also be a foreign individual, a foreign trust, or a partnership. So here it's telling us that X makes payment to W in year 3. So let's look at how that works out. So now, don't be confused. X is owned by W. W formed this. So if you look in the prior videos, video 1 and 2, you would see that W formed this company, but we're continuing from there. So in this case, in year 3, X make payment to W. You have X here making payment all the way to its parent, W. Now the next one is Z makes a payment to Y. So let's see how that flowchart is going to work. So you have Z here. In the prior videos, we've explained that W owns X, W also owns Y. But then these two companies also came together to form Z, which is also a single member LLC. But in year 3, you have Z making some payment or transfers to Y. So that all looks good. The reason why we're saying this is we want you to know how the ownership structure looks like. W owns X, W owns Y, and then X and Y came together at some point to form Z. But in this case, for year 3 transactions, you have Z paying money to Y. And then the same year 3, you have X paying money to W. So let's roll back and see how that works. Without the other complications, you see that X is sending money to W, Z is sending money to Y. So that all looks good. So we bring in the other complication just to show you that the ownership structure. Now let's look at the year 3 analysis. In year 3, based on all the facts that the IRS has provided here, the IRS says that X, Y, and Z are all disregarded entities separate from W. So X, Y, and Z, they are all disregarded entities. X is a disregarded entity because it's owned by W, which is a single member. Y is a disregarded entity because it's owned by the same W here. X and Y came together to form Z. But the question is, why is Z not a partnership? Why is the IRS still considering Z as a U.S. single member LLC? Now, the reason is simple. Because you have X, which is a disregarded entity, Y is a disregarded entity, which is owned by the same parent. They cannot form a partnership. It's a flow through. It's so transparent that you can see that it's actually W that owns Z. And that is why this cannot be considered as a multiple member LLC or a partnership. It still maintains the characteristics as a single member LLC. IRS also says that X, Y, and Z are treated as an entity separate from W and classified as a domestic corporation for the purpose of section 1.6038A. Now, what all this means is that, yes, we get it that these 3 entities are disregarded entities, but for the purpose of filing Form 5472, they are now seen as a reporting corporation or a domestic corporation just to file the information return. The fact that section 1.6038A requires you to file an information return does not make these entities a taxable entity. The LLC still maintains its same characteristic. The LLC does not pay its own taxes. It passes on income to its owner. It is only a domestic corporation or a reporting corporation only for the limited purpose of filing the pro forma 1120 and 5472. It does not make your entity a full-blown corporation for all purposes. Only the limited purpose of filing Form 5472. I know this gets very confusing, so I always need to stress on it. Now let's look at each of the transactions that happen and look at the IRS analysis. So the IRS says that each of the transactions in year 3 is a reportable transaction with respect to X. Now when we say with respect to X, it means that X is the company or the entity that's responsible for filing the pro forma 1120 and 5472 or the information return, and not the W. W does not file the information return. It's only X that files the information return. So let's roll back and see how that works. X will file an information return because during the year it's actually transferred payment to AW. So if we're preparing this information return, we would call this as a distribution. It's a distribution or a draw going out to the parent, which is the foreign corporation. So that all looks good. Now we go to the second one, and it says that each of the transaction in year 3 is a reportable transaction with respect to Y. Why does Y has a reportable transaction? It's pretty simple. Let's roll back and see. Now Y has a reportable transaction because it received money from Z. As you can see from here, money went from Z to Y. So Y is going to report on 5472 that it received money from a related party here, which is Z. And that's why Y has a reportable transaction. Let's go back again. Each of the transaction in year 3 is also a reportable transaction with respect to Z. Now, why does Z has a reportable transaction? Let's roll back and see. Because Z makes payment to Y. So Z is going to file 5472 and report the payment it made to Y. It's as simple as that. So you could see that there's going to be a duplication of reporting, and one would ask, why can all these companies consolidate their reporting because it's owned by one person? But the IRS does not like it. The IRS is saying that each of these entities need to file 5472 separately. You cannot file a consolidated return. So in this case, you would have Z filing and reporting payment it made to Y, and then Y will also file and report the payment it received from Z. So there's going to be some duplicative reporting here. So now that we've done with all the three reporting entities here, let's look at what the IRS is saying in conclusion. So the IRS is saying that therefore X, Y, and Z all have a reported as section 1.6038A, which basically means that there's three companies X, Y, Z for year 3. They need to file pro forma 1120 and 5472. They also have a record maintenance requirement for year 3. So think about it. Anytime you have a reportable transaction, you also have record maintenance requirement. And that record maintenance requirement basically means that for each of these transactions here, you need to have a proper set of books or record or receipt or wire payment transfers to show how those transactions came about, so that in the future, when the IRS comes asking questions, you can be able to produce those information pretty quickly. Okay, so let's look at the due date. Now, the due date for filing these returns, because these transactions happen in year 3, the due date is generally going to be April 15, year 4. Calendar year generally ends on December 31st. So after your calendar year have ended December 31st, year 3, you wait until 15th day of the 4th month. When we say 15th day of the 4th month, that's going to be April 15, year 4. X is going to have the same date, Y is going to have the same due date, and then Z is going to have the same due date. The only time you may not be required to file this return on April 15 is when you have filed an extension. If you have filed a valid extension, that gives you more time to file the return all the way to October 15. But you must file your extension on or before April 15. If April 15 falls on a holiday or weekend, you can wait till the next business day to file the return. But it is always advisable to file these returns very early. So for example, after the end of the calendar year, December 31st, the following year, you can start filing these returns around January, February, March, and somewhere in April. But do not file them after April 15. If you're going to file them after April 15, make sure you've used Form 7004 to get a valid extension. And the valid extension needs to be filed on or before April 15. So for example, if you wait after April 15 and file an extension on April 16, the extension is invalid and your return is basically late. So I hope this information helps you out, and if you have any questions, please use the link below and book an appointment with me. Thank you.